Hello and welcome to this week's BizSmart Lunch and Learn webinar. Our weekly webinars are aimed to provide advice and share knowledge amongst business owners. If you would like to keep up to date on our latest webinars, then please make sure you follow us on SlideShare or subscribe to our YouTube channel. And you can also access all of our resources for business owners by downloading the BizSmart app. Our host joining me today is BizSmart Select Member and Advisor Ian Priest. Thank you, Ian. Over to you.
Thank you. So, yeah, it's all about the cash. And the first thing to say is businesses don't go bust because they make losses. Businesses go bust because they run out of cash. Even very profitable businesses can go bust by running out of cash. So you must know where the cash is. Okay, so what we're going to have a look at today is working capital, how to generate cash, how you can get funding to assist your working capital, quick look at borrowing money and getting the right terms, restructuring existing borrowings where it's appropriate, and a few thoughts on managing your lending relationships. So a little bit about me. I worked in banks for over 31 years. And my last role was managing partner for Clydesdale Bank for Herefordshire and Worcestershire. I've been a credit manager in the advances department, and I've been in the underperforming and recovery team, which is great fun on occasions. I joined Independent Banking Consultants in 2011, and in the last 7 years I've raised about £38 million for my clients. IBC, it says I've been trading for over 7 years. IBC, Independent Banking Consultants, actually have been going for over 20 years. We arrange finance for businesses, anything from working capital, import, property, whether that's owner-occupied mortgages or investment or development, funding for plant and equipment. We also specialise in non-bank finance. We also support borrowers with their renewal of facilities, dealing with problem lenders. Yes, sometimes banks have problem customers, very often clients have problem lenders, and supporting borrowers who are in that nasty intensive care department at their bank. So, working capital and generating cash. The first thing is don't start with borrowing. Have a close look at your business. As I said before, businesses go bust because they run out of cash, but equally it's cash that repays debt and pays dividends. Profits are all well and good, but if they're not generating cash, there's not a lot you can do with them. So the first question you should be asking, am I making the right level of profit? If there isn't enough profit being generated by your business, if your margins are too thin, then you need to seriously ask questions about what you're doing, how much you're paying for things, what your costs are, and how much you're charging for your product or service, whether there is scope to input to increase your profits. If the profit levels are appropriate, then you need to understand where the cash is going. And there are only actually so many places you can look: down the back of the sofa, under the bed. No, seriously, cash can go out as dividends. It goes out to the tax man. It can be tied up in stock. It can be tied up in your debtors. It can be tied up in creditors if you're paying them too quickly. And it can be tied up in fixed assets. And you need to look at all those and ask yourself, is this right? Is this sensible? Yeah. Stock. Is the amount of stock you're holding appropriate? Can you reduce the amount of stock you've got on the shelves? Can you move towards a just-in-time? Delivery of stock so that you're not paying for it till you need it. I had a client a few years ago who was manufacturing fairly basic metal products, and they decided they could get them made in China so much cheaper than making them themselves. And they nearly crippled, in fact, they did cripple the business doing it, because what they forgot was to get them in from China at this cheap price, they had got to buy them by multiple container loads, and they'd got 2 or 3 years stock then on the shelves that they couldn't turn into cash. As we've put on the screen already, dividends, yeah, if you're taking too much cash out, well, that's a personal decision you've got to look at, and whether you need to take that much cash or whether you can't afford to leave some in the business. Tax is not something you can do a lot about, or can you? Are you claiming R&D tax credits? Are there any allowances you can claim? Are you on the correct VAT regime? Can you switch to cash accounting rather than paying your VAT as you raise your invoices? We've already talked about stock. Are stock levels appropriate? Is there any dead stock you can offload? Can you change your procedures to get it in? I've seen so many businesses with stock on the shelves that they'll never, ever, ever use. It's dead money. Get rid. Get the cash back in. Debtors. Are you collecting your debtors efficiently? Are your credit processes in place to minimise bad debts and to improve the speed of collection? Whose credit terms are you actually working on? Yours? Or are you letting people pay you when they feel like it? Your terms of trade should be clear, they should be set out, and they should be accepted by both parties. Then you know where you are. Have good debtor collection processes. Have somebody speaking regularly to your customers' accounts department to make sure they've got everything they need to be able to pay your invoice, that they've got all the bits of paper that need to go with it, all the certificates, all the signed off bits. Make sure there's nothing in there that's going to hold them up from paying your invoice, so that you get the cash washing through. Beware to offer the temptation to offer discounts for prompt payment. Typically what happens, you raise your invoice for £1,000, you say you'll offer a 5% discount if they pay it within so many days. Guess what? They'll take the 5% discount and still pay you when they feel like it. Oh, it said there was a 5% discount on the invoice. You try arguing with them after the event, you're never going to win. Can you extend your credit terms? Can you get more funding out of your creditors? Are you actually paying them early? This is going to sound ridiculous, but I had a client who was getting divorced. He needed to raise £600,000, and the only way he thought he was going to do that was if the business borrowed the money. I went in and started work, and after 12 hours went to him and told him he didn't actually need to borrow any money at all. What he needed to do was ask his soon-to-be ex-wife, who was his finance controller, to leave now and stop paying creditors' invoices the day they land on the desk. If he'd taken 45 days trade credit, he'd have had £700,000 or £800,000 in his bank account within 6 weeks. His wife was paying the creditors, paying all invoices the day they arrived on her desk. Absolutely bonkers. Fixed assets. People forget about the cash tied up in buildings, in machinery, in vehicles. Do you still need them? Are they still appropriate for your use? Are they being fully utilised? Again, I had a client who deals in fairly big chunky pieces of machinery, and in their yard they've got lots of engines, motors, bits of these big chunky bits of steel. You start asking the question, well, what's that for? Oh, that's for a machine that went out of production 20 years ago. They got tens of thousands of pounds in for selling it as scrap. It had been written off the balance sheet years before. It was just sitting there. slowly rusting away, and yet at the time price of scrap was high. Get it gone, get the yard tidied up, get the cash in. So yeah, do we still need them? Ask that about everything. Or the other question is, do we really need to spend money on a new building, a new machine, new cars? You should only be spending money on things if it's going to add value. So a new machine that's going to make you more efficient, going to make more for less, great use of cash. Vehicles to deliver, to get stuff out, to give the right impression, fine. But, you know, matching number plates, flagpoles, fish tanks, they're all the things that bankers shudder at when they see them, because it's a ridiculous use of cash within a business. And I apologise to anybody who's got synchronised number plates, but hey, you have to generalise occasionally. So only when you've examined every element of the business internally should you start thinking about borrowing, because you probably find lots of cash hiding in the business if only you go and look for it. In the same way, you've probably got lots of new business hiding in your filing cabinet with your existing customer base if you go and ask them. So if you do need to borrow some money, then the best way to finance working capital is what? Invoice discounting, factoring, overdrafts. Well, they're all different and they've all got their own pros and cons. So, overdrafts. Not limed by lenders. Sorry, there's a typo on there. Not liked by lenders. You know, banks really don't like overdrafts. They're not structured. They're not controlled. And actually, from a bank's perspective, they're an awful use of capital, which is a scarce resource within banks. And overdrafts are particularly inefficient for lenders. Great for customers, but very inefficient for the banks. So overdrafts are generally limited by the type of business and the value of any security that's available. Used to be a rule of thumb of 25 to 50% of funding against debtors, but now I know at least one bank that says overdraft should be no more than 5% of turnover. Where they've got that figure from beats me, but that's a rule they work to. You know, think about it, 5% of your turnover is nothing. Overdrafts are best used for infrequent borrowing. You dip into and out of an overdraft. It shouldn't be there as a hardcore solid facility being used all the time. Having said that, it's almost certainly cheaper than invoice finance. And banks are very nervous about potential legal issues on relying on debentures against debtor books following the ruling in Brumark, which effectively puts the banks at the back of the queue behind some of the unsecured creditors. So, invoice finance. Banks really like invoice finance. It's a structured product. It's linked directly to the debtor book. And strangely, it's not classed as lending because the bank's buying the ledger off you. So they don't have to put as much capital towards it, and they charge more for it. What's not to like? There's different types of invoice finance, from confidential invoice discounting, often referred to as CID, to full factoring, where the bank or the lender actually buys the book off you and they collect it and they control it and they do all the debtor monitoring on it. As I said, the lender owns the book debts. Your funding, therefore, is limited by the value of your debtor ledger and the quality of your customers. It's more about your customers than it is about you. It's the quality of your customers that depends how much funding you'll get against your ledger. So the lender will prepay a set percentage of approved invoices for an agreed period, usually 70 to 85%. I've seen it as high as 95% on some ledgers. And and usually it's for 90 days after the month end, so it can be for up to 120 days. Much better suited to high usage, particularly if you're financing growth. Invoice finance works very, very well for stable and growing businesses. Can be dangerous in a business that's declining because you have funding 1 month based on X ledger, and if your turnover is dropping, obviously your funding the next month is based on a much lower figure, and it accelerates the decline in the cash that's generated. So, invoice finance is much more complex to administer than an overdraft facility. I mean, monitoring on an overdraft facility, what do? You look at your bank statement every now and then and make sure you've still got some headroom. Invoice finance, you have got to be uploading figures daily, weekly, monthly. You've got to do a reconciliation. So there is a lot more administration work to do with an invoice finance facility. They are very, very complicated pricing structures within invoice finance, and can make negotiating a good deal difficult for the unwary. You've got service charges, you've got usage fees, which is what they call the interest. So you pay for an administration charge for having the facility. That's usually expressed as a percentage of your turnover. It might be a fixed fee. There's probably minimum fees on that each month. And then you've got the actual charge for what you use on top of that. If it goes past 90 or 120 days, you might have refactoring charges where they take it off and put it back on again and charge you all over again for it. So very, very difficult to get the pricing where you think it is compared to where the finance company knows it is. So a big word of caution with invoice finance, there's lots of moving parts. Approved debtors, they might disallow some of your debtors, usually governed by credit limits that are set on particular customers. There might be retentions because a customer, you've gone above a credit limit on a customer, the concentration, you've got too much with one customer because you've gone above an average 90 days on your debtor turn, or all sorts of reasons that can be retentions on there. Recourse periods, that's whether it's 90 days from the month end, 60 days from the month end. Debt turn restrictions, I've already mentioned, that's the average time it takes to collect your debtors. So if that goes above 90 days, normally they'll put some more restrictions on. And debtor concentrations, very often they'll say you can have a limit of £1 million on this customer, but you can't have more than 35% of your book with any one customer, which suddenly means your £1 million might be out the door, but they've become 45% of your ledger, and therefore 10% of it is not allowed. Very, very difficult to manage, and you need to understand all those moving parts. I saw one business last year that had been operated on an overdraft for forever. They're in the steel industry. There were no real issues with their overdraft, except their bank persuaded them to move to an invoice finance facility because it would be cheaper and more flexible. Really struggling to get my head around how it would be cheaper, and it definitely wasn't more flexible, because a few weeks after they switched to invoice finance, the steel industry had a bit of a blip. Tata were threatening to close down Port Talbot. British Steel, what's left of it, had got a bit of an issue, and the credit insurers pulled all the credit limits on all the steel companies. So every single one of their customers had a zero credit limit. So any money that came in got grabbed by the lender, because guess what? They were over their credit limit of zero on every single customer. So the lender grabbed all the cash that came in over the next 10 weeks, they were bust. Nothing they could do about it. So, the different types of invoice finance product. Confidential invoice discounting from a customer's perspective is always going to be the best. Your customers almost certainly not aware of its use unless you're with an independent financing company and your customers happen to do a search at Companies House and see there's a charge registered by, let's say, Bibby, they're one of the independents, and then they'll work out that you use an invoice finance, but there's nothing on your invoices, there's nothing to tell them they're not notified that you're invoice discounting. So it's only if they go searching for a charge at Companies House that they'd find out. Funding will be assessed against your total sales ledger. You do your own credit control. It's a lot easier to administer than factoring because generally you're uploading totals during the month of invoices raised and payments that have come in. It's only at the end of the month you have to do a reconciliation. It's a higher risk to the lender, so they are more selective on who they make that type of facility available to. The opposite end of the scale is what's called full factoring. This is disclosed. Your customers will be aware that you're using factoring, and normally on your invoice it will say all payments should be made to Bibby at this bank account and this sort code or at this address. So it will say on your invoice that they make payment to the factoring company. Effectively, you're funding against each individual invoice. You have to load details of the invoice onto their system, and they make availability against those invoices. Lender does all the credit control. So a lot more work at your end, there's a lot more work at the lender's end, and it is therefore more expensive than a confidential invoice discount facility, even though the lender's risk is lower. And it does mean that actually there's much more availability of that type of facility than there is confidential. There are facilities called CHOCs, and I'll remember in a second what CHOCs means. Customer handles own collection. There you go, CHOCs, I got there. It's a halfway house. Effectively, it's a factoring deal rather than a confidential invoice finance, but the customer does all their own debtor management. So yes, your clients will probably still know that you're factoring, but they aren't being chased by the factoring company for payments. You do your own chasing on there. And you can also do what's called single invoice, where you're only invoicing one or two financing one or two invoices rather than your whole ledger. It's for each individual invoice that you do, it is a lot more expensive. But if it's not something you're going to use very often, it can be a lot cheaper than paying a minimum service fee for 12 months on a facility you don't need to use. So it is worth keeping in mind, particularly, I've got a client that gets a big job every August that they have to finance. The rest of the year, their cash flow is okay. It wouldn't be worth them paying a service charge for a facility they're not going to use for 11 out of 12 months. So it's actually cheaper to pay a more expensive funding cost for that one invoice than it is to have the facility that they're not going to use. Okay, so that's a quick overlook at overdrafts and invoice finance. Borrowing money and getting the right terms. That's a dark art in itself. Banks differ more than people realise. Everybody thinks the banks are pretty much vanilla, they're all the same. They aren't. the terms you can get from different banks and different people within banks can differ hugely. I've done a deal in the last few weeks where we were doing a property mortgage, and I asked them to add a little bit onto the base loan to cover the arrangement fee and the valuation and the costs. Most of the lenders said that was absolutely fine, and they were quoting rates of, well, we went from 2.45 up to about 3.5 across the different banks. One of them came back and said, yeah, we'll do the property loan at 3.5, but the extra 10 grand for the arrangement fees and the valuation, we'll do that on a 5-year loan rather than adding it onto the 20-year loan, and we're going to charge you 14% for that. You aren't, go away. So yeah, there can be huge differences. There is what we call an opaque and flawed credit processes. The way banks work doesn't help clients. If you think about the process, the lender will come out and see you, possibly. Depends on your turnover. A lot of them now it's done over the telephone. Now, how they can judge a business on the phone is beyond me. The manager makes some notes. The manager writes a credit paper, and the credit paper then goes to a credit underwriter for approval. Well, there's lots of areas where that can go horribly wrong. The bank manager's notes might be incomplete. He might not have asked the right questions. He might have misunderstood, got hold of the wrong end of the stick. He's going to write a credit paper that's based on flawed information. He's going to have unconscious biases. We all do, built into him that or her, that's then going to get reflected in that credit paper. And then it's going to a third party who's never spoken to you. They don't know whether there's any flaws in that paper or whether it's right, wrong, or indifferent. They're making an assessment based on something that could be completely cuckoo. So lots of reasons why banks get their credit process wrong. Wrong rather than wrong. My Black Country accent coming out there. All bankers, whether they're good, bad, or indifferent, are time challenged. None of them got enough time to do the job properly, so they do tend to say no to lots of things because they're too busy, it's too messy, they don't understand it, they've got easier things on their desk to do. As I already said, they can make mistakes, they can get hold of the wrong end of the stick, and then that all works against you. They all tell me they haven't got any sales targets at the moment. I'm not sure I entirely believe them, but they're all telling me they haven't got any sales targets. Yeah, right. I've worked in that environment long enough to know that's not true. When it gets to a credit manager's desk, you've got a real tension between frontline bankers and credit managers. Frontline bankers' job is to generate income. Credit managers' job is to minimize risk, and the two oppose each other. So there is always going to be an inherent problem there, and if the banker hasn't got hold of the information, hasn't got all the information, hasn't got the right information, he's going to struggle to get it past a credit manager. Again, it's working against the client. Late notification of lending terms, yeah, very often you'll find that they'll tell you if something's fine, it's okay, and then it's several weeks down the line before you actually find out what the real terms are, and there's a couple of nasties sneaked in there, and by that time it's probably too late to go and look somewhere else for it. I've seen that time and time again. Oh, the bank manager said it was going to be fine, and then this appeared. And you've run out of time to look anywhere else for it. It can be catastrophic. So, start early and talk to 3 or 4 lenders. Yeah, shop around. If you haven't got time to shop around, get somebody to do it for you. Focus on information that's relevant to the lending decision. Make sure you answer the questions before they ask them. Present solutions. Don't leave lenders to their own devices. If you want an overdraft, tell them you want an overdraft. If you want a term loan, tell them you want a term loan. Tell them why you want it on a term loan. Don't let them come up with a structure on their own, because they might want then approve it on terms like invoice finance that might not be appropriate for you. Don't rush in. Consider all the viable options, which is why late presentation of the lending terms can be a nightmare. And don't be seduced by interest rates and headline fees. The devil is always in the detail. There was one lender that was notorious for quoting, particularly on invoice finance, much lower interest rates than anybody else in the market. What they didn't tell anybody was they had a minimum base rate of 5%. So lender A was quoting a margin of 4% over a base rate of 4.5. These guys were quoting a margin of 2, but over a base of 5, so it was 7. And lots of people got sucked in because they assumed base rate meant base rate. It doesn't. So yeah, the more influence and input you have to the lending decision, the better. Be prepared to switch lender for the right terms. It's good business practice. And as a general rule, banks don't offer the best terms to their existing customers. They offer the best terms they think they'll get away with. They tend to offer the very best terms to new potential customers. So inertia not changing can be very detrimental to your wealth. And yeah, it's a complicated business. Get some qualified support, some help. So how do IBC help? We are qualified and independent, so we give best advice. We have a sound reputation with managers and credit managers in lots of different lending institutions. We assess each case and discuss the options with the borrower before we approach lenders. We draft the credit paper that the lenders use, and we get the clients to review those to make sure we haven't got any duff information in there or any wrong assumptions. And we present solutions. We suggest how they structure the facility. We don't just tell them we want to borrow X pounds. We tell them how to structure it, how to make it work. And we get lenders to compete with each other to win the business. And that's why we get really good pricing for our clients. Restructuring existing borrowings. If the bank doesn't review your facilities, well, the bank will review your facilities annually. They might just not tell you about it, except if they're charging you a renewal fee. But you should review your requirements annually. Are they still appropriate? Do you still need that level of overdraft facility, or are you paying for a facility you're not using and are unlikely to use? Arrangement fees and renewal fees can be quite chunky. Why pay for it if you're not going to use it? Consider a switch from overdraft to invoice finance. If cash is getting tight, and invoice finance will generate more cash, and you can put that to profitable use. Consider whether you should be using documentary credits or import loans to structure your finance against specific projects correctly. Extend loan repayment terms or align them with seasonal trading. If you have a loan over 20 years rather than 10 years, it is going to cost you a lot more money in the long run, but it might save you a lot of cash in the short term, and short-term cash might be a lot more valuable to you. When I studied economics, there was a nasty little beast we used to consider called discounted future cash flows, which basically says the effect of inflation erodes the value of future pounds. So if something's going to cost you a lot more in 20 years' time, are you really worried about it? Because it ain't going to be worth very much in 20 years' time. There was a big kerfuffle a few years ago, gone, 30 years ago, about endowment mortgages mis-selling and people being sold endowment mortgages. We never actually found out if it was going to be a problem because they were all cancelled and switched to repayment mortgages pretty much. But consider my dad paid £2,500 for his bungalow when he bought it in 1963. If he'd never paid anything off it over the last 50 years, well, £2,500 you put on your credit card now and wouldn't worry about it too much. Yet, it was a hell of a lot of money when he borrowed it to buy the house. So inflation erodes the value of long-term debt. Be prepared to offer security for increased limits. Banks aren't charities. They do have a duty to try and get the money back, and a large part of that is by taking security to protect their position. If you haven't got security, see whether you or the bank can use the Enterprise Finance Loan Guarantee Scheme. That's what it's there for. Investigate other banks and other non-bank lenders. There are hundreds and hundreds of lenders out there now. Some of them you wouldn't want to go anywhere near, but quite a lot of them are reputable. Okay. I remember being put through a training course some years ago on how to manage your manager. Well, you should manage your banking manager and your relationship with them, because the better the relationship you have with the bank, the more likely you are to get your facilities renewed without any grief, without them jacking up the interest rate, without them demanding more security or causing you all sorts of problems. So produce good quality, timely financial information. It ain't that difficult now with the number of good quality bookkeeping systems there are. Get a good, decent bookkeeper to do it for you if you haven't got the time yourself. It will pay for itself many times over. Review your budgets annually. Make sure that you've got enough facilities to do what you want to do or you're planning to do in the year. The last time to be thinking about raising extra finance is when you've run out of money. Prepare thoroughly for bank review meetings. If you know they're going to want to ask about your customers, the risk of your customers, have that information to hand. Know who your customers are, know who your market is, know who you're targeting your new products at. Be realistic in your expectations. As I said, banks aren't charities. They're not going to give you £1 million overdraft facility just because you smile sweetly at them. So be realistic. The more you're asking for, the more likely you are to have to provide some form of security. Do not always take what your lender says at face value. Quite an enormous amount of, I was going to say bullshit, but that's probably not very polite, gobbledygook comes out of bankers' mouths on a regular basis. Think about what they've said and logic test it. Test it with another lender. Don't ignore problems. The worst thing you can ever do is hope it'll go away, that something will turn up. It won't. It'll get worse. Deal with it. And again, if you're concerned, if you need support, get some qualified advice and somebody to help you. Yeah, arranging finance is a dark art. Keeping it almost as complicated. Take advice and guidance. You may want to talk to me, you may want to talk to your accountant, but get somebody to help you if you're stuck. Don't be a slave to inertia. You may have only yourself to blame. If anybody wants to contact me, my details are there, and I'm sure that the slides will be sent out. If anybody wants to chat, please pick the phone up or drop me an email. Thank you very much for listening.
Thank you, Ian. You've got some questions that have come through, ready for you to answer. The first one is from Claire, and she asks, why is the bank trying to push me towards invoice finance rather than an overdraft?
Okay, I did touch on this earlier. Overdrafts are very inefficient from a bank's capital point of view. They used to have to put aside 8% capital for a loan. So on a £100,000 overdraft, that would be £8,000 worth of the bank's capital put aside to cover that loan. And that's what they have to get their return on. Invoice finance uses no capital because they're buying the ledger off you. They can charge a lot more for invoice finance because you've got the service fee and the usage fee. There is much less risk in an invoice finance facility because they can step in at any time and see exactly what they're funding against, where your overdraft, you could have spent it on anything. So yeah, it's lack of structure, lack of security. Debenture lending is not very secure because court rulings like Bromark have gone against the banks, and they can earn a lot more out of an invoice finance facility. So yeah, that's why they are going down that route.
Okay, thank you. Hope that helps. We've got another question from Philip. What is the best way to structure payment terms for work you do for someone like an agency whose own cash flow becomes strained if there's a gap between paying you and receiving money from their end client?
Okay. You should always make very clear at the outset of any contractual arrangement what your payment terms are and whose payment terms you are working to. So on your contract that you sign, you should make your payment terms clear. Some people put it on the back of their invoices, but if you're not clear about what your payment terms are and they haven't accepted them, you're stuck with when they want to pay you. Now, just because you've got clear payment terms doesn't always mean you're going to get paid on those payment terms, but it's the first step if you have to take action with the county court, is to be able to prove what your payment terms were and that they haven't stuck to it. So if you haven't got any payment terms and you haven't made them clear, you're on a losing streak right from the outset. So always, always, always make it clear what your payment terms are. Now, there are going to be occasions when your client can't comply with that. As you say, in this instance, there may be a gap between when they're supposed to pay you and they haven't been paid by their client. To what extent you could say that's their problem, they still owe you the money and they should pay it. If they haven't got the cash, that's easier said than it is done. But if you haven't got payment terms that have been accepted by both parties, you really are struggling if you want to take it to court to get paid. So that's where invoice finance can have its advantages, because you get the cash up front, and as long as they pay typically within 120 days, the funder will cover that. Can be a problem if it drops off the end at 120 days, because then the funder will effectively take that off the next invoice that you raise. But again, you need to have clear credit terms, and you need to be aware what those are and how that's working through. But always a good starting point to set your own credit terms and have that clear in writing. All my contracts say payment due within 14 days.
Perfect. Thank you. Thank you again, Ian, for hosting today's webinar. As you mentioned earlier, I will be sending out a copy of this presentation with Ian's contact details out to you all very shortly. So please do email him direct if you have any further questions. But just before we close, a quick reminder, if you would like to keep up to date on our latest webinars, please make sure you follow us on SlideShare or subscribe to our YouTube channel. And you can also access all of our resources for business owners by downloading the BizSmart app. That's the end of today's webinar. Thank you all for listening, and we hope you can join us again very soon.